so much, and thanks to the organizers for including our paper. So this is joint work with Christine Ballur from Berkeley. So what we are trying to do is look at how does the setup of the market affect the stability of liquidity provision, and how do some of these more modern markets that we see in these decentralized exchanges actually compare to limit order markets. So most of the existing markets are some kind of version of an electronic limit order book, and people think this is the best way to provide liquidity. And the key assumption that we see there is that liquidity provision is perfectly competitive and the market makers obtain zero profits. But that's a little bit at odds with all the investments into this high frequency trading technology, why people co-locate an exchange computer. And we argued that this is because liquidity providers try to carve out some kind of competitive niche and extract rents in these limit order markets. So in this kind of context, we compare this liquidity provision from these limit order markets to liquidity pools, and want to see how these liquidity pools can do. So what we find is that these liquidity pools can dominate limit order markets when there is a lot of uninformed traders, when prices don't move by much, and when the incentives to invest in this high frequency trading technology are strong. So this empirically, when we look at the data, we find that these liquidity pools track the limit order market prices pretty well, that they can have a lower price impact, and that they also have a lower variation in price impact, which is important for institutional traders who want to sell large quantities and want to have a predictable price impact. So we built a theory model in the paper that I don't really have time to go through, but just the basic idea. So we have an asset that has a price of P0, and the price can either stay at P0, in which case a noise trader arrives and trades, or there could be an innovation in the price with probability alpha that the price either goes up or goes down. And in this case, an informed trader or an informed arbitrageur arrives at the market and tries to trade. Everybody's risk neutral, and we want to compare limit order markets with these new liquidity pools in this setting. So usually in a standard type of Kyle model, we have some competitive liquidity providers who gain from trading with the liquidity trader and lose from trading with the arbitrageur. And so they set the price just to break even on average. But here in our model, we extend this setup a little bit where we have competitive liquidity providers that can invest in the technology that gives them some kind of edge where they have some market power. So we can think about this as high frequency trading, or we can think about that as learning fast if an institutional trader arrives and wants to trade a large quantity, and then I can cancel my order quicker than other liquidity providers and I'm out. So some kind of idea of competitive edge. And if they do get this competitive edge, we model this very simple in our paper that they become a monopolist liquidity provider, at least for the time of the trade, when the trade occurs, and then they charge a high spread. So this technology is wasteful and costly and is not socially desirable. So we compare that to a decentralized exchange, and specifically, our motivation was the Uniswap system, which is a large decentralized finance swap facility. It's a backbone of the DeFi ecosystem. It trades, I think, way more now. So every time I have to redo my slides, I find that the number is too low. So I think it trades way over $3 billion, and the posted liquidity just on Uniswap is really high. Since that time, a lot of other clones from Uniswap have emerged while we were working on this paper. So SushiSwap has emerged, and a lot of other ones have a reason to. So Uniswap, for example, comprises of tens of thousands of liquidity pools, and anybody can be a liquidity provider. I'm a liquidity provider in Uniswap. It's fairly straightforward. So how do you do that? So you trade and send token some tokens to a smart contract, which is on the Ethereum blockchain. Essentially, you send some tokens to a computer program and you receive some other tokens back. How does the contract determine how many tokens to exchange for other tokens? So these pools, say, for example, in a trade, one token against another token. So we label one token ETH here and another one token. And suppose the balance of the pool is E0, T0. So we are at this red point. Then the market is defined by this, what's called a bonding curve, which is just that the product of E0 and T0 has to be some kind of constant. Now, if somebody sends tokens to the pool, the token balance of that pool goes up from T0 to T1. And how many ETH do you get back? Well, you can determine that graphically by looking at the new equilibrium point, which also must be on the curve. So we see along the y-axis here, the difference between E0 and E1 is how many tokens you actually get back when you trade with that smart contract. So how can we see this kind of framework in our in the context of our model? So one thing to note is that these liquidity providers earn a fee per trade. So they earn a constant small fee. At the moment, it's 30 basis points per trade. And what happens? So to this pool, a liquidity trader could arrive and there's no change in the true price. But let's look at this in a graph. What happens if the liquidity trader arrives is that pushes the price from E0, T0 to E1, T1. And then the price that the contract quotes is actually not really reflective of the true value. So what happens is that an arbitrageur arrives and pushes the price right back to where it was. Since you always trade along this bonding curve, if you trade in this direction, somebody pushes the price in this direction and then it gets pushed back, you end up exactly where you started. So if a liquidity trader arrives, this is actually not a bad thing for the liquidity providers, because those people who provide the liquidity of the pool actually have no loss, but they collect 2 times the fee, which is a gain for them. Now suppose that there was a change in the true price and the true price moves from E0 to T1, then this liquidity pool quotes a stale price that is not reflected of the true fundamental anymore. So the price is stale, and somebody will come and take advantage of this stale price. So the pool gets picked off and the liquidity providers who contribute the inventory of that pool lose out. So how do we then think about the economics of these pools? Well, if you think about the optimal pool size, there is some revenue from fees that these liquidity providers get, and there's some losses from quoting stale prices. So in equilibrium, we have to find that the equilibrium pool size has to trade off that fee revenue against these losses. The beautiful thing is that the size of the pool actually determines also the curvature of this bonding curve. So if the pool size goes down, then this curve becomes more concave, more convex, sorry. And so that means that there is a higher price impact. So the price impact actually adjusts endogenously here in this market. As people will withdraw liquidity, the price impact gets larger. So why can these pools be better than the limit order markets? So in these limit order markets, there is an incentive to invest in this high-speed trading technology and to gain this competitive edge. And you kind of have to do that to be part of the game. So I could not be a liquidity provider on the New York Stock Exchange. I would not have the technology to do that. In these liquidity pools, however, losses get neutralized. And so everybody shares the loss equally. There's no point in trying to be faster than somebody else. You cannot build some kind of monopoly in these markets. So for me, it's easy to be a liquidity provider on Uniswap. I just deposit my money there and I don't really have to think very much about it. So in the paper, we derive some condition when these liquidity traders actually prefer pools over a limit order market. So to take this to the data, we collect information on all the Uniswap liquidity pools. And so we have about 36,000 individual liquidity pools. There was a version 1 of the protocol that started in 2018 and was replaced with version 2 throughout the sample period. So we have more V2 pools than V1 pools. We have about 47 million transactions on Uniswap. So these are about 1 million liquidity injections, about 600,000 withdrawals of liquidity, and 45 million trades of tokens. So one of the predictions of our model was that the pool size is decreasing in the innovation of the price. So by how much can the price change when new information arises? And we measure that empirically. We approximate that with volatility. And we do find that the equilibrium pool size actually decreases in the volatility of the token. So the other thing that we predict from our model is that the pool size is increasing in uninformed trading. So how do we proxy for uninformed trading? Well, one crude proxy is volume, that we argue that there's only so much information that comes out every day, and there's a resulting volume that corresponds to this. So any extra volume beyond that point would be uninformed trading. And so if we do that, we think about it like that, then we find that volume is actually positively correlated with pool size. The same logic applies for the number of trades. So there's so many trades that informed traders have every day based on information. And through to the microstructure of these systems, it's not really beneficial to split up your trade in many small trades. So the informed trader just trades the whole amount. And so any extra number of trades that we observe might be uninformed trades. And we do see that the pool size increases in this. Our best measure of uninformed trading is what's called reversals. So this is the logic that I showed you before in the graph, where an uninformed trader arrives and pushes the price out of the equilibrium, and then an arbitrage comes along and pushes the price right back to the equilibrium price. So we look for these patterns in the data and look for cases where somebody trades a certain amount in a pool, and right after the next transaction, somebody else comes, an arbitrage comes and pushes the price right back to where it was. We can identify these patterns and find that the pool size actually increases in the amount of these short-term reversals. We also find that liquidity provision is very stable in these kind of liquidity pools. So we have very few liquidity withdrawals. We can trace the individual liquidity providers by the Ethereum wallet address. And we find that there is only 1,800 events where the same address is used and adds and withdraws liquidity in a short period of time. And most of those are very small. So we see that the median size is $140. So this is just somebody trying to say, hey, does this really work? If I check liquidity, will I get my money back? So testing things out. So if you look at this more seriously and look at deposits and withdrawals over $1,000, we have 18 observations out of our 45 million where liquidity is added and withdrawn. So we don't see that happening very often. And liquidity provision is actually very stable. So this is a graph for minute by minute data on May 19th, 21, where the ETH to the dollar price dropped by 40%. So this is about twice as much as in the October 87 crash, just to give an order of magnitude. And we see here in orange the price drop. And the blue line is the amount of liquidity that was withdrawn from these pools during that crisis period. And there's two things noteworthy. First of all, so that liquidity withdrawal is on the right scale here. And we see that only about 17% of liquidity was withdrawn from liquidity pools for ETH and US dollar at the time, which is not very much. Second, during the really kind of hardest time when the prices collapsed here and hit the bottom, there was still a lot of liquidity available for people to trade with. So at that time, only 2% of liquidity was withdrawn. And actually, the withdrawal, most of the withdrawal of liquidity happened after prices had substantially recovered again here and went back up. So to make a comparison to a more direct comparison to a limit on a market, we look at Binance data, and we look at token pairs that trade both on Binance and on Uniswap. And we have to eliminate, there's some trading volume issues. And so we ended up with about 27 cross-listed tokens. And I want to show you some pictures rather than regression results, which are in the paper. So first of all, we look here at the pricing error. That's on the right scale, and that's the blue line. And we see that in general, the pricing error is very small, except for the very early part where we see substantial pricing errors. But that was because the pool was very small at that time. That was just right after the start of the pool. So on the left scale, we see the pool size in logs. And you see that initially pricing errors were big, but once the pool size hits about 100 ETH, then we see that the size of the amount of the pricing error was really, really small. This is a typical picture for a day where we see the prices on Binance in blue and the prices on Uniswap in orange, and they track really well. Now, let me say that this is not easy to arbitrage those two markets, because Uniswap is on the blockchain, and Binance is a centralized exchange. So to do an arbitrage trade, you have to move the money, the coins out of the centralized exchange, out of Binance, which has substantial withdrawal fees. And then you have to wait for this transaction to go through. And then you can trade on Uniswap, and then you have to send your tokens back to Binance, which again requires a blockchain transaction and a substantial amount of time. Actually, we found it quite surprising that the prices tracked it well. So here is a graph of the price impact on Uniswap versus Binance. And what we see is that on Uniswap, which are these two lines at the very bottom, one measures the theory measure and one measures the empirical measure on Uniswap, that the price impact on Uniswap is very, very small. We see that the price impact on Binance is actually higher, and moreover, the price impact on Binance is very volatile. So for a large institutional trader, a stable and very predictable price impact can be beneficial. And so this is how these decentralized markets can actually really make a point relative to the centralized markets. We see that this is reflected. People seem to appreciate that. So here we see the relative trading volume on Binance versus Uniswap for a particular pool. And we see that initially when the pool started out, of course, Binance was by far the leader in trading volume. But after a while, the pool on Uniswap grew larger, and now Uniswap is trading more than Binance is trading. And what's also interesting to note here is that volume is actually quite correlated across these two markets, again, which is surprising given that they're not that closely integrated. So I hope to present some evidence on that these new markets work. The investors in the liquidity providers in the limit order market have an incentive to invest in this wasteful high-frequency trading technology. And a liquidity pool, an automated market maker, is there, and the losses from adverse selection are neutralized, and therefore you don't have to invest in any high-frequency trading technology. So this can be more efficient, and we do find evidence empirically that liquidity pools can dominate the limit order market. And the last thing I want to mention is that Binance actually recognizes this, and they started their own blockchain, the Binance Smart Chain, with the main purpose of running an automated market maker, a Uniswap clone on their own blockchain. So now we have the Binance Smart Chain that has several of these decentralized exchanges running on it, most notably PancakeSwap. And so that's a big contributor to Binance volume right now. And so they have also made one of these decentralized markets their own to better compete in this crypto.